Hi everyone, it's Alex here at Sestrian Capital Research. Welcome to another of our earnings videos as we're now in the thick of tech earnings season. If you haven't caught our post on Microsoft earnings, then you can do that elsewhere on our YouTube channel. Go take a look. On your screen right now is our standard disclaimer. In short, nothing in this video constitutes investment advice of any kind. Just take a moment to read that disclaimer. Let's turn to AMD numbers first of all. So right here we have the quarterly numbers up to and including the quarter printed yesterday. That's the December quarter, and then the revenue guidance for next quarter, the March 24 quarter. So growth this quarter was excellent, ticked up to 10% growth versus the same period last year. Trailing 12-month revenue growth, though, dropped down a point to -4%, and that's because this big 16% growth quarter in December 22 dropped out of the trailing 12-month calculation. So the company turned in just shy of $23 billion of revenue in the last 12 months. And again, this quarter was a good one, grew at 10% year on year. Now the guidance for next quarter is a slowdown again to just 1%. If you look back at AMD seasonality, there's nothing, necessarily structural to Q1 that means it's slowing. So that guidance is a little bit of a concern, which no doubt will be playing heavily on the stock. Gross margin held steady at 51% in the quarter, 48% on a trailing 12-month basis. Gross margin's been pretty steady for AMD for quite some time now, so no particular concerns there. EBITDA margins came in at 23% on a TTM basis, flat on the last two quarters, down from their peak of around 30% in the middle of 2022. But 23% margins for a fabless semiconductor business, that's okay, that's all right. What was more of a concern this quarter was cash flow. So peak cash flow margins for AMD have been in the 20-21% range, and that was at the end of 21, beginning of 2022. They've been in decline really since then and hit a low last quarter, the September quarter, at 12% on a trailing 12-month basis. This quarter, though, down to 7% on a trailing 12-month basis. Now, if you look at why that was, well, EBITDA margins were flat, so it's not in the accounting earnings. CapEx was not particularly different for the last 2-3 quarters. The story is in outflow into working capital, and put simply, working capital means the rate at which you collect cash from your customers versus pay it out to your suppliers, put very simply. So if you collect cash in faster than you pay cash out, then you can expect this change in net working capital number to be positive. If you pay cash out faster than you collect cash in, it'll be negative. So if you look at, for instance, subscription software companies, they'll typically have a positive number for change in net working capital because they get paid upfront by their customers, but pay their suppliers in arrears. In semiconductor companies, very often you do see an outflow into working capital because they're not really able to charge their customers up front. Their customers are typically big, ugly hardware companies that have a lot of power in their supply chains and will pay significantly in arrears. Whereas if you're fabless like AMD and you have to pay your foundry partner to make the things, and again, you don't have a great deal of power in your supply chain. So that the change in working capital is negative at all is sort of structural to what AMD does. But look at the change this quarter: $1.2 billion outflow versus $110 million outflow in the same quarter last year, and as a result, that just drags down cash flow to that 7% TTM margin. That's not a good look, and one would like to see that improve in the coming quarters. Balance sheet fine, $3.4 billion of net cash. That's okay. Wolf's not going to be at the door anytime soon. Valuation is stretched, I think. You have just on the raw numbers, and of course you can argue about the future, but looking at the actual reality of the past, we have negative 4% growth on a TTM basis in revenue, and yet the market's asking you to pay, even after the drop after hours, 11.5 times trading revenue. You'll pay 13 times or so for Microsoft, which is growing at positive 12% and has higher cash flow margins. EBITDA multiple 50 times trading 12-month EBITDA, that's a big number, and 159 times trading 12-month cash flow. So whichever way you look at it, that's an expensive fundamental valuation. Now that may not matter to the stock. People get all sorts of bent out of shape as regards what one should pay for stock A or B. I'm not really sure that matters, but as an input, as a matter of fact, those valuations do look a little stretched to me. Stock chart, here we go. Now we charted AMD quite successfully from the middle of its, let's just say Q4 2018 lows, and it put in a large degree wave one up, moving from $17 in 2018 up to $164 at the November 2021 high. So nearly a 10x return in just 3 years, pretty remarkable. And the stock tracks quite nicely to technicals. So if you look at the correction into the 2022 lows, the October lows, it's pretty much a 78.6 Fibonacci retrace of that wave one up, which is a nice technical pattern. It means that it's an institutionally traded stock. If it's charting to those sort of retraces, that's not a coincidence. And if you look at the volume by price indicator, that's these gray bars on the right hand side, we went to buy or accumulate on AMD at between $55 and about $91, which at the time, before the stock got into this price range above, there was a big spike in buying in this level, and that's paid off. So, if you'd bought the stock in our accumulation zone between $55 and let's call it $90, then worst case, even if you paid $90, you'd have almost doubled your money at this point. And best case, if you paid $55, then you would have around trebled your money. So the power of buying at these wave two lows, particularly major wave two lows like we had at the end of 2022, is there to see. And this chart method we use, this combined Elliott wave and Fibonacci method with this overlay of Wyckoff rotation, we do that for good reason, which is we're looking to spot the point at which institutions accumulate stocks like AMD. Now, this chart isn't different to what we were posting in late 22, early 23. It's the same chart. It's got the same accumulate and markup zones. Right now, the stock is in markup. We rate it a hold. Late money is coming in, buying the stock, and is pushing the stock up. And that late money comes with an AI narrative. People want into AMD because it's the second biggest player in AI after NVIDIA, second biggest semiconductor player at any rate. And where NVIDIA goes, probably to a lesser degree, AMD follows. So that's AMD. Okay earnings, growth good, cash flow not so good, balance sheet okay, valuation stretched. The stock, though, if the market is flat or up, we suspect the stock can keep moving up just on that AI narrative. And again, what you have here, and you can see from the low volumes up at these levels, this is late money now coming in to buy. So don't underestimate the power of late money. There's a lot of money sat on the sidelines in money market funds right now of people who are only now tempted back into equities now that many of them have reached all-time highs once more. AMD's no exception. And so don't underestimate the power of late money. You can keep pushing a stock up further than maybe expected. But again, this was a stock we were at buy at between 55 and 90, and so that's paid off pretty nicely so far. Thanks for listening to our work as always. Don't forget to follow us on YouTube. You can do so. You can follow us and subscribe in the links on this page, and look out for the rest of our work at cestriancapitalresearch.com. Thanks, folks. Talk to you soon.